Hello and welcome to the Real Vision Daily Briefing. It's Thursday, October 21st, 2021. I'm Maggie Lake, and today with me is Tom Thornton of Hedge Fund Telemetry. Tom, it's great to see you again, and you haven't been on with us for a while. We were wondering and worried, but you've been slaving on the new website. Before we even start, bring us up to date. Is it live? What's going on?
Yes, I've been busy. Some people asked if I was banned from Real Vision. I tried to make up some really, salacious story, but no, I've been very busy redoing a website, and it's finally done and working, which is lovely. And it's been a really tough last week getting everybody, all the subscribers on and logged in. So happy it's over, and now we can build from it. So it's good. Happy to be back.
Great. Congratulations. It's not easy birthing a website, but we look forward to it, and I'm sure
Sort of like
everyone's excited.
birth, yeah.
Sort of like, but it's
Long
tough.
hours, labor. Oh yeah.
Yes, and you have to take care of it forever and ever now. So,
That's
but
true.
listen, let's get a quick snapshot, bring everybody up to date because we just closed here for U.S. equity markets on some of the action today. A little bit mixed on U.S. equities. The Dow lower, S&P pretty much flat. The Nasdaq higher, leading the way today. We saw a little bit of a breather in commodities. Concerns around China's economy slowing, stronger U.S. dollars crimping that market. And bond yields on the move higher again as traders now pricing in, I think it's 2 rate hikes by the end of 2022. But Tom, I think the most interesting action today was really in some of the individual names. And as you rightly point out in your daily note, it was a weird day.
Yeah, really weird. We had, the Trump SPAC um, hitting the same day of the WeWork SPAC, and just the massive amount of volume on the Trump SPAC, and I think it was up 350%. It was up 400% at one moment. Just insane. And look, I will say this: I'm not a Trump supporter or any. I hate politics personally, but someone said to me, "What if 10% of all those Trump supporters give him $10 a month as a subscription for his new social media thing? That's $1.2 billion in revenue for him." And it's just insane, honestly. And I think people are going to really tune in. I do. I think it's like if there
Well,
was
they're
like a
going to tune
freeway
in
chase.
initially, right? I mean, that's
Oh
the,
yeah, it's going to
there's
be
that sort of
sure.
the spectacle around this is almost
Yeah.
irresistible.
It's like a freeway chase channel. You,
Yeah.
you don't want to admit that you're watching it, but you want to see what happens at the end. And it's just that's kind of how I see it with
Yeah.
the Trump channel. And
I mean, just on the price action alone, though, I mean, we've got the phenomena of all of the outlets for trading now. When you see a move like that with anything, I mean, any kind of IPO, and especially a SPAC, I mean, is it imaginable that people will chase this higher, or should they just buckle their seatbelts for volatility?
I'm not getting involved in this one.
That's fair enough,
You
Tom.
could do that
You
too.
want your
But
website to stay up and running and not crash, right? I mean,
yeah,
we
I
don't
mean,
want
look,
to.
I have my own universe of what I trade and what I look at, and this definitely falls outside of that. I don't chase things that I'm not familiar with or I can't value.
Right.
But yeah, this thing could go to 100. This thing could go to 200. I mean, we've seen all these crazy, wacky moves for the last year and a half. So why not? Why? Sure, it can. It
Yeah.
could also
Does
go right
WeWork
back.
fit into that same category? I mean, this was a company that tried to IPO, had to pull it, had all sorts of fundamental issues. I mean, this is a sort of a branded entity we know, uh, but it's also coming at a time when I mean, I was just talking today with someone who's traveling, and maybe 20% capacity, 30% capacity where they were going. I mean, people are not really back to work still. Um, is this a different beast than what we're seeing with the Trump SPAC?
Oh, absolutely. You can actually value WeWork in some form. Um, and I think I looked at it earlier today, and it had a $9 billion valuation. And the last SoftBank raise that they did was around 47 billion. and they were just basically bidding it higher and hoping that they could go do an IPO and cash out of it. But SoftBank's, just taking a big hit on this, and here it is. It's out now. It's worth $9 billion. It'll be, it can go up a little bit more. There's a lot of competition I see with WeWork now as well. I live in Greenwich, Connecticut, and the CEO of Saks lives here as well. And they just launched a thing called Saks Works, and it's a very similar concept. And it's in an old Ralph Lauren building here. There's a restaurant. You can go and pay a subscription and go sit down and do your work. I'm not sure it's going to work in my town. Maybe people in New York City will go to the Saks, flagship and do it there. But there's a lot of competition, and you're right. People aren't going back to work. I think that's something that's going to be very difficult to get people back in the office until really this COVID is super far in the rearview mirror, and it's not there yet.
Yeah. So you really need to you need to understand future of work. You need to understand commercial real estate. You need to understand business travel. All of those issues. I think if you're going to take a look at that WeWork and try to value it out. I want to stay with the individual stocks because we did have some of these sort of stories, but they're widely held. Tesla. We have to talk about Tesla. Came out with earnings after the close on Wednesday. The stock is up today, but there was a lot of action in the options market, right? A lot of people weighing in on this. Well, what was your takeaway from both the call and also the price action or the market action you saw today?
Right. Full disclosure, I'm short Tesla and long.
I think almost everyone knows that, right?
Yeah, it's fine.
This is a long-held position of yours.
Send them my way. But the stock's gone up for the last year and a half or year, basically, on a gamma squeeze, and that's a situation where there is a very large buyer of short-term out-of-the-money calls, and then they're selling short-term out-of-the-money puts and causing the dealers to have to hedge and buy stock. It brings in the day traders. They follow along with the options, but this gamma squeeze is really something else. And, I don't know who's the big $10 million buyer of options every week that, who, I don't know, maybe it's someone who has the most to benefit from Tesla going up. It's just crazy. But the thing, Tesla was more like the boring company last night because they didn't have Elon on the call, and Elon on a conference call is really something else because he mumbles, stumbles, gets upset with analysts. He comes out with ideas that I don't even think the board of directors knows about at that time. I think he invented the insurance product on one conference call. Yeah. And so it was boring because he wasn't on it. They had their CFO and several executives, and it was a very boring, straightforward call. But the stock is trading at like an absurd valuation. I think the stock in the last 2 weeks has gone up, someone said 1.5 Fords, which makes, very little sense to me.
Yeah.
The problem is with Tesla is that they do have some negative catalysts coming their way. One is that competition is in the market now, especially in Europe, and a ton of electric vehicles are in China. And, they're starting to show up in the U.S. Porsche, Audi, BMW has a few. The Ford is making a big presence. I like Ford stock a lot. I've talked about it on Real Vision.
I'm glad you brought that up because I was wondering if there was an alternative, to that you were looking at.
Volkswagen has electric vehicles. I think Volkswagen trades at 6 times earnings. Tesla's trading at 100 plus times earnings. It just makes very little sense. And so you have this competition, and we all know that. That's all out there. But they're full self-driving, which has been they've been charging people since 2016. Well, it's coming every 3 months or 6 months, and they have these beta versions, and they just beta, and you see these videos on YouTube, and it's not going, it's going in the lane. They got to pull it. It's not ready yet, and it's
Mm.
going to be far from ready. And now you have the FTC with the wrath of Lena Khan, who's a very aggressive antitrust advocate as
Mm.
well. She's going to be a real tough cookie when it comes to consumer protection. They're going to look at the marketing for full self-driving. I know this because I've spoken with our Connecticut Senator Blumenthal. I spoke to him recently, and not that I was, advocating or, I just wanted to hear what he had to say, and I've known him. So they're talking to the FTC, and now, like, the safety regulators just brought on a person who is a strong, she may not even get the position because she's spoken outwardly against Elon Musk and their full self-driving because it doesn't really work. And
Mm.
so she just came on. If she comes on, I think the full self-driving is going to have it could get banned. They could outlaw it, and it's going to cause chaos for all the Tesla fans and probably the stock as well. So I think those are some negative catalysts that are out there, and they're opening up factories. Yeah, that could be positive, but that's going to test their demand. So if they've
Yeah.
got more output, they better be able to bring in, the sales. They can't make excuses. And of course, then there's supply shortages and the
I was going
supply
to say
chain,
that's a
chips and everything.
that's a good list of things to be worried about, and we didn't even get to supply yet, which is an issue for everyone when you're talking about the EV market and batteries and the disruptions and the cost of materials too. Although some people thought that they handled that well and showed that they were a little bit more competitive maybe than some of the others in the space on that. I know that will be the beginning of what will be a robust conversation with you and the many Tesla bulls and longs out there. So we'll let that take place outside, maybe on the exchange. But I want to you bring up
Sorry, I'm
something
just
that we've
looking.
been.
I'm I have a pair trade. I'm long Twitter. It's down 7.5%, but I'm long Twitter, so I'm basically back to my cost. But Snapchat is my long, as well as Facebook, or excuse me, as a short. Facebook and Snapchat. Snapchat is down 28%. Yay me. Okay, so I get
we got
one every once in a while.
yeah, exactly, and we got to give it a shout out when it happens. Speaking of all of these tech names, I want to bring our viewers a little clip of a conversation Mark Ritchie spoke with Carlos Asilas this week. And he said something very interesting about big cap tech names. I'm not saying he was speaking about these names in particular that you just mentioned, but he said big cap tech is a must hold for investors in the market environment we're in. Have a listen to what he said.
If you look at the traditional investor, right, it has been followed this paradigm of the 60-40, right? 60% equities or something close to it, and 40% bonds. And with rates as low as they are, particularly on an inflation-adjusted basis, that model is broken, right? That model is broken. It's recipe for disaster. So, particularly after the 2019. So what that means is that you know one should own a lot more risk assets, whether it's equities, commodities, reflationary stories, right? This law of liquidity is likely to remain abundant for quite some time. So I think you need fixed income replacements, instruments that will replace the fixed income investments that you own prior to 2020, right? And I think this mega cap tech names in the U.S. are as good a replacement vehicle to fixed income as one can think of. They have very strong balance sheets. Their net cash positions is enormous. Their moats are extremely strong, with offering significant growth opportunities. And so, buying back shares, which and very, very high margins. There's some regulatory risk, but it's more than priced into the valuation. So I think that's part of the answer in terms of that. The change in the changes associated with rates being so low.
And just a reminder, viewers can hear that entire interview on all tiers of Real Vision. What do you make of that, Tom?
Well, Honestly, it's if you take those five stocks or the big mega cap stocks, they're paying dividends, they're steady, they print money, they're not cheap. He's right, and if you've been penalized in this market if you haven't owned them. I can say that I have not owned them. I did own them in 2020, but I'm short a couple of them, Facebook, Apple, but they're not bad companies. I just think they're overdone here. But he's right. You can't buy bonds. I'm short bonds, and people are looking for an alternative to bonds. And the funny thing is, people buy stocks not necessarily for the capital appreciation. They're buying it for the good yield, S&P stocks, basically. And people have been buying bonds for the capital appreciation. They're not buying the 10-year and saying, boy, I'm really thrilled to get, $1.50 or 1.5% for, or 1.68% right now, almost 1.69. That's not what they're doing. They've traded bonds successfully as they've appreciated, and now that's starting to turn. So people are looking for alternatives. They've moved to Bitcoin. I mean, Kathy Wood calls Bitcoin a bond alternative, and maybe she's right.
I want to rattle through a couple things. I'm not going to forget about Bitcoin. Let's put a placeholder there. You just mentioned Snap earnings are out. You just mentioned your happy position on that, but that stock is getting slammed. You can't. We talk about big cap tech or big tech or technology in general. It's hard to group it all together. Nathan is asking for your thoughts on the growth tech sector for the rest of Q4. If you just said you've owned them and you're shorting some of them, I mean, do you feel that we're going to pull back? Do you feel like they have room to run? I mean, we saw the leadership change and then it kind of came back. It seems like people are split on this.
Well, you had yesterday, the big cap tech was down, and then today they're up, and you've had this flip flop, and you had financials up recently, and they were down today, and energy down today. So you've had this growth value type flip flop. Look, I think my view is that rates are going higher. I think that will hurt the growthier type names out there in the market. Look, we've got earnings coming up with the big boys next week. Apple, Amazon, Microsoft. I don't anticipate any, major surprises. But you could see maybe with Apple, they'll talk a little bit more about supply chain issues, chip shortages. Microsoft will probably put up a pretty good quarter with their cloud business doing just fine. Amazon is always a little bit quirky. You never know how it's going to go. But so big tech, yeah, if you've owned them for a while, you really have no reason to sell them. If you're looking to buy them right now, I'd probably not do that. So that's kind of how I see it. And look, people rarely sell at highs, and they only sell. And you see these huge volume moves on the downside because they get afraid. So they sell when things go down.
Yeah.
And there's really no reason for people to be selling stocks, and that's why you have this light volume on this last bounce.
Yeah.
So it's just until we see some weakness, it's maybe status quo.
Yeah, it's been hard to turn away, even if you feel like it's getting a little overpriced. Tom, we have Muchir asking, what does DMARC say about Bitcoin and Ethereum?
Okay, I was looking at Bitcoin today on with the DMARC charts, and we recently, look, it had a $65 or 65,000 approximately wave 3 price objective. So we achieved that. We've had recently a new DMARC sequential 13. We haven't, today's pullback, sort of qualifies that. I think 57,000 is what I told my people that if that broke, that would probably mean a deeper pullback. Look, the Bitcoin has just been amazing. And market sentiment, which I track through the daily sentiment index, and we have charts on our website, had Bitcoin yesterday at 92% bulls. And I think since it's a newer sentiment indicator for us, that's the highest we've ever seen. It probably, I mean, when you get above 80%, that's the extreme zone. But 92, anything that when it gets above 90, I generally could say that you should expect a bit of a pullback. And look, you also have how many Bitcoin ETFs based on futures are coming out. There's, I think, one tomorrow.
Yes, there is. How do you feel about that?
Yeah, the problem I have is any type of ETF or ETN or that is based off of futures and not the physical has that, you have an expense on that, and there's also the difficulty with the futures role. Another thing I saw, Katie Greipel from Bloomberg, butchered her name, sorry, Katie. She was talking about how the exchange has limits, position limits, and they're coming really close to hitting those position limits per month, how many contracts you can have per month. They're going to raise it, I believe. But the problem is they've had such big inflows that they may max out on the near-term month and then have to go out further months to have that exposure. And when you have to go out further out there, that's when the roll, could get a little dicey. And if you're so far out, you're going to have another issue with liquidity, perhaps, if it goes down. So look, if you're going to buy Bitcoin and don't screw around with the ETFs. That's how I look at it.
Yeah,
I mean,
and I was pleased to see a really robust conversation around that immediately as these funds hit, because I think ETFs are known to people and might have been attractive to a lot of people. But it was great to see the cost conversation right away happening. We've seen. I want to switch gears just a little bit. You mentioned earlier that Cathie Wood. It's not really switching gears, but it's a pivot to talking about bonds a little bit, because you talked about Cathie Wood mentioning, and she's among a group of people who say, listen, Bitcoin is an alternative to bonds. So much of what we're seeing with in the bond market is being dominated by this inflation narrative right now, and we saw that again today. We had in the middle of earnings, Unilever, big global products companies saying that they're going to raise prices by 4%, so pushing along their wholesale costs to consumers. That was, affirmation of some people saying, listen, this isn't going away. We had strong housing data out of the US. And you're seeing that rate talk really filter into rising rate expectation filter into bonds. We have a chart of the 5-year break even, which measures the difference or the gap between treasury bonds and treasury inflation protected securities, those TIPS. It's really sort of an future inflation expectation gauge. And, some people were talking about it today saying, listen, look how high that is. That shows that inflation, maybe this isn't transitory. The market believes it's not transitory. The market pricing in higher interest rates. How is that affecting your trading strategy? Are you also worried about higher rates, and how are you positioning around that?
Well, if viewers can see right on that right-hand side, it really spiked the last 2 days, and it broke out of this channel here, this range. And on my DeMark chart, I just looked, it's on day 3 of 13. So it has the potential to continue higher to get to that exhaustion signal of the 13. So look, my big narrative is, yes, we will see higher rates, and it's across the board happening. The 210 spread was actually a little flatter today, and partly just, the 2-year just went nuts, and I'm just looking at some of my screen right here. So that, I think, was part of the reason why financials backed off. I'd like to be back in financials. I'd like to be back in some energy. I just sold a lot of energy. I'm actually short.
Yeah, that was part of your trade, right? You're shorting.
Yeah, I'm really set up very short right now. And even though everybody looks at it and goes, oh, how could you short this market? Well, Snapchat's down 24% or 25% right now. There are places to go and find, issues out there that aren't necessarily going up with the market. And so it's not easy, but this is kind of what I was trained to do when I way back worked at a hedge fund that was generally, for the most part, net short.
Mm. Do you uh, has the sort of forecast for higher rates, has that been fully priced in? I mean, do you expect this to continue, for yields to continue to move higher? And what does that do to asset prices, both here in the US, and we actually have a question coming in about Germany as well, about bonds. Would you expect, I mean, Germany's still negative. Would you expect that yield movement to follow in Europe as well? Are they just lagging where we are already going?
Well, rates are going up across the board everywhere. And if you look at Boone's, it's been even more straight up in a very steady pattern, more so than the U.S. Bond market yields. So look, rates are going to go higher. You have inflation, and it's worldwide. And I've actually been a little bit on the transitory side, and then I see the structural side. So I'm not like everything is going to keep going up. You will see things moderate. I think there's a lot of businesses out there that are going to pass it on to the consumer. That's happening. I mean, Procter and Gamble. I mean, they're raising prices, and they're saying, look, we're raising our guidance for the year as well. They reported the other day, and I thought their report was much better than how the market took it. But Unilever, others out there, they're going to do it. One of my trades, and this is kind of a theme I've been working on. I've been short some restaurants because of the food inflation. I mean,
So tough for them. I mean, they had
and labor costs are
shut
going up.
down,
I mean,
and then yeah, they're getting hit on every front, really.
yeah, it's terrible. But I also think that retailers are going to have a difficult time into the holidays. It can be, look, the supply chain thing, it goes around, and at the bottom is the consumer. Right next to the consumer is that retailer who had to go through all, the full chain. And they may not have enough product on their shelves, and they're going to have a tough time with labor costs. So I think that there's going to be a lot of retailers out there struggling, and I don't think the market's necessarily going to give them a pass. And the market this has been a market in the last 2 years with COVID and, the trade war and, supply chain and whatever. They've given the market a pass on all these things, but these excuses, and yes, they're valid, and that's it. But look, my thought is rates are going to go higher. The Treasury's got to issue a ton of debt to pay for all this good times we've just had, and they haven't really raised a lot of debt in the last 9 months because they've just been rolling over short term and debt that it's just been a roll. So now they're going to just the debt ceiling's raised, so they're going to go nuts, and we'll see how well the auctions are. And you still have foreign buyers. Japan's been buying, but they sold a lot, and they're not quite back with the tick data, which is the inflows from foreign countries. Did not show them buying a lot of debt. But look, would you rather have a 1.7 10-year in the U.S. or something negative in Europe? I mean, it's pretty obvious. People will find a level to where they say, yes, I will buy this. And I think that we could see well over 2% on both the 10 and 30-year, maybe 2.5. I mean, I'm not going to go too far out, but maybe even 3% on the 10-year down the road. And
what does that mean for equities?
Hurt tech and hurt equities, and then again, the market forgives everything or ignores things. So maybe they'll say, "Oh, it's not that bad." It's also, the risk is also the rate of change, and if the rate of change just starts to go a little too fast, you're going to catch people very off guard. And I think that was a spooky thing that we had recently.
That's, I think, the worry. You know, if this is gradual, then it can be priced in and adjusted to. If it's fast and catches people off, that's what's dangerous. Tom, we are out of time. It is so good to have you back. We are thrilled the website is up and running, and now you have no excuse. We will have you in our midst a little
All
more
right,
often
Maggie.
now.
Yeah.
Thank you so
Well, thanks
much.
for having me, and thanks to all the Real Vision subscribers. It was real fun meeting a lot of them at the recent Real Vision gathering, the party in New York City. That was really cool. And
Great.
see
And
you
we
again
will,
soon.
yeah, and absolutely. And we will keep everyone posted on when the next live event is happening and how you can participate. Thanks for being with us. Tomorrow, I sit down with Jim Bianco, another regular on the daily briefing. We look forward to that.
Smart
In
guy.
the meantime, yeah, can't wait to hear what he says. In the meantime, thanks so much to all of you. Take good care and good luck out there. We'll see you soon. The conversation continues on the exchange.